Hello everybody, I'm Sylvia. I would like to continue what was explained by Yulianti. In chapter 5 of the book, Burton J. Malkin explained about the technical and the fundamental analysis and the difference between the two. The fundamental analysis is the technique of applying the tenets of the firm's foundation theory to the selection of individual stocks. The technical analysis is the method of predicting the appropriate time to buy or to sell a stock used by those believing in the castle in the air view of the stock pricing. What can a chart tell us? The first principle of technical analysis is that all information about earnings, dividends, and the future performance of a company is automatically reflected in the company's past market prices. The second principle is that the price tends to move in a trend. A stock that is rising tends to keep on rising, whereas a stock at rest tends to remain at rest. There are vertical lines whose bottom is at stock's low for the day and whose top is the high. The line is crossed to indicate the closing price for the day. One of the first things the chart looks for is a trend. And now we're going to chapter 6 of the book. In this chapter, Burton J. Malkin explained what is the technical analysis and the relation to the random walk theory. The technician believes that the knowledge of a stock's past behavior can help predict its probable future behavior, while chartists believe momentum exists in the market. Investors should therefore buy stocks that are rising and continue to hold their strong stocks. Should the stocks begin to fall, investors are advised to sell. What are often called persistent patterns in the stock market occur no more frequently than the runs of luck in the fortunes in any gambler. This is what economists mean when they say that stock prices behave very much like a random walk. And now, some elaborate technical systems in approaching the stocks. The first is the filter systems. The second is the Dow theory. The third is the relative strength system. The fourth is the price volume system, and the fifth is the reading chart patterns. Well, other technical theories that can help us lose money also. The first is the Hamline indicators, the second is the Super Bowl indicators, the third is the lot theory, the fourth is dogs of the Dow, the fifth is in January effect, the sixth a few more systems, and the technical market curious. So, the past history of the stock prices cannot be used to predict the future in any meaningful way. Using technical analysis for market timing is very dangerous because there's a long-term uptrend in the stock market. It can be very risky to be in cash. Now we finally arrive in chapter 7, where Market will explain on how good is fundamental analysis and the market hypothesis. He believes there are 5 factors that help explain why security analysts are difficult in predicting the future. The first is the influence of the random events, and the second is the pressure of dubious reporting earnings through creative accounting procedures. The third is errors made by analysts themselves. The fourth is loss of the best analysts to the sales desk, to portfolio management, or to hedge funds. And the fifth is the conflict of interest between the research and the investment banking departments. Market touches about the efficient market hypothesis that the technical analysis looking at past stock prices cannot help investors. Prices move from period to period very much like a random walk. And in the end of this chapter, Market also take a note of high frequency trading, HFT. HFT involves the placement of high-speed computers in close proximity to the stock market, serves to give some participants the ability to buy and sell stocks faster than the blink of an eye. Another major advantage of HFT is that it ensures that the exchange traded broad-based index fund. HFT makes markets more efficient and reinforces the advantage of index funds investing. And now, Wayuna Hidayat will continue the review. Thank you.